A new era for taxpayers. Unveiling the 2025-26 tax regime, the Union Budget 2025-26, presented by our Finance Minister Nirmala Sitharaman, has brought significant changes to the income tax landscape in India. This new regime aims to simplify the tax structure and provide relief to taxpayers. One of the key highlights is the substantial increase in the personal income tax exemption threshold. This change is expected to boost the disposable income of the middle class, leading to increased spending and economic growth. The government's focus on simplifying the tax system is evident in the revised tax slabs and rates. The new tax regime offers taxpayers a simpler way to calculate their tax liability, with fewer deductions and exemptions to consider. This straightforward approach aims to reduce the complexity often associated with filing income tax returns. While the new regime offers lower tax rates, it's important to note that it eliminates many of the deductions and exemptions available under the old regime. Taxpayers need to carefully evaluate their financial situation and investment strategies to determine which regime is more beneficial for them. The government's decision to increase the basic exemption limit and revise the tax slabs reflects its commitment to providing relief to taxpayers. These changes are expected to have a positive impact on household budgets and encourage economic activity across the country. As we delve deeper into the specifics of the new tax regime, we'll provide a clear understanding of how these changes will affect your tax liability and financial planning for the coming fiscal year. Decoding the new tax slabs and rates. What's changed? The most significant change in the new tax regime is the increase in the personal income tax exemption threshold. The government has raised this threshold from INR 7 lakh to INR 1.2 million. This means that individuals earning up to INR 1.2 million per annum will not have to pay any income tax. This is a substantial increase from the previous threshold and is expected to benefit a large section of taxpayers. This move aims to put more money in the hands of the taxpayers, encouraging spending and boosting economic growth. In addition to raising the exemption limit, the government has also revised the income tax slabs and rates. The new tax slabs are designed to provide relief to taxpayers across different income levels. The revised tax rates are generally lower than the previous regime, making the tax structure more progressive. The government has introduced a new tax rate of 5% for income between INR 4 lakh and INR 8 lakh. This new slab will provide significant relief to taxpayers in this income bracket. Here's a breakdown of the new tax slabs and rates for FY 2025-26. Income up to INR 4 lakh, 0% tax. Income from INR 4 lakh to INR 8 lakh, 5% tax. Income from INR 8 lakh to INR 12 lakh, 10% tax. Income from INR 12 lakh to INR 16 lakh, 15% tax. Income from INR 16 lakh to INR 20 lakh, 20% tax. Income from INR 20 lakh to INR 24 lakh, 25% tax. Income above INR 24 lakh, 30% tax. These new tax slabs and rates are applicable to individuals opting for the new tax regime. It's crucial to understand that the new regime comes with its own set of deductions and exemptions, which are different from the old regime. Taxpayers need to carefully evaluate both regimes to determine which one is more beneficial for their financial situation. Bold verses. New navigating the crossroads of tax regimes. The introduction of the new tax regime has created a dilemma for taxpayers. Should they stick with the old regime or switch to the new one? The answer depends on a variety of factors, including income level, investment strategy, and eligibility for various deductions and exemptions. The old tax regime, with its numerous deductions and exemptions, has been the go-to option for many taxpayers for years. However, the new tax regime, with its lower tax rates and simpler structure, is an attractive alternative, especially for those who find it challenging to navigate the complexities of the old system. One of the main differences between the two regimes lies in the availability of deductions and exemptions. The old regime offers a wide array of deductions, such as those for investments under Section 80C, medical insurance premiums under Section 80D, and home loan interest payments under Section 24. These deductions can significantly reduce your taxable income and, consequently, your tax liability. However, the new regime does away with most of these deductions, opting for a more streamlined approach. While the new regime offers lower tax rates, it's essential to consider whether you can forgo the benefits of the deductions available under the old regime. For those with substantial investments in tax-saving instruments, such as Public Provident Fund (PPF), National Pension System (NPS), or equity-linked savings schemes (LSS), sticking with the old regime might be more beneficial. Additionally, if you have a home loan or pay significant medical insurance premiums, the old regime's deductions could lead to lower tax outgo. Making informed decisions, marginal relief, and choosing the right regime. The government has introduced a provision called marginal relief to ensure a smooth transition for taxpayers whose income slightly exceeds a particular tax slab. This provision ensures that individuals do not end up paying more tax than the additional income they earn above a specific threshold. Marginal relief is particularly beneficial for those whose income falls just above a tax slab, preventing a sudden jump in their tax liability due to the higher tax rate applicable to the next slab. This provision ensures that the tax system remains progressive and fair for all taxpayers. To understand how marginal relief works, let's consider an example. Suppose an individual's income is INR 12.1 lakh. Without marginal relief, their income would fall under the 15% tax slab, resulting in a tax liability of INR 61,500. However, with marginal relief, their tax liability is reduced to INR 10,000. This ensures that they do not face a disproportionately high tax burden due to a marginal increase in their income. Choosing the right tax regime is crucial for effective tax planning. Taxpayers need to carefully evaluate their income, investments, and eligibility for various deductions and exemptions under both regimes. Using online tax calculators and seeking advice from financial advisors can help in making an informed decision. It's important to remember that the best choice may vary from person to person based on their individual financial circumstances. In conclusion, while the new tax regime offers a simpler structure and potentially lower tax rates, it requires careful consideration and comparison with the old regime. The decision of which regime to choose should be based on individual financial goals and circumstances. Taking the time to understand the nuances of both regimes and leveraging available resources will empower taxpayers to make informed decisions that optimize their tax liability.